Good evening, everybody. On behalf of 5 Live, welcome. Hit the subscribe button to get more insightful webinars like this. I'm Mayuresh Joshi. I head the equity research at William O'Neill India, and we are here to discuss how the economic implications are for the 3C'S, which have clearly rattled Dalal Street at this point of time. So the last few weeks, crude, corona, and credit risk averseness have clearly created a huge impact for our markets. What this has actually done in terms of dragging the global indices down, along with what we've seen as sharp correction of almost 35 odd percent for our own markets, and a smart bounce back that we have now witnessed in the global and the local markets as well. We'll discuss the probable factors that affected these markets in the downturn, and how are we looking at the markets at this point of time. So clearly, I think the pandemic which hit us, the economic and the financial implications both were a large unknown over the last few weeks. The markets are still trying to grapple with the fact on how the entire fallout will take place over the next few weeks. Now, it's an obvious reaction in terms of the IMF projections that have come through. GDP estimates have actually been cut down for the global economy, the developed economies as well, and even the emerging economies, including India and China, quite significantly for this financial year. Now, IMF does expect a V-shaped recovery to probably come through from the second half and the latter part of FY21. But how will that play out in terms of demand expected to come back? And how much of that demand actually comes back and sustains in a more sustainable fashion that continues over the next few months once it starts coming back on normalization over the next few quarters, is a thing that only numbers will reflect from both corporate earnings and from each country's individual balance sheet. Because I think the inflation that has probably happened, or the inflated fiscal deficit numbers which will come through as a percentage of GDP, the additional borrowing that individual governments will have to do, I think that will also have and leave a mark in terms of how markets will behave. The obvious reaction obviously will also be seen and get reflected by the G-Secs or the bond yields. And the bond yields will be the first factor going forward in terms of both the supply and demand factors, as I said. The government on the Indian context has still stuck with the objective and the target of borrowing 7.8 trillion odd. But in my opinion, I think far larger figure might be required, because if a financial package is one is really expecting the exchequer to probably announce over the next few days, specifically for the stretched out sectors, I think that puts an additional pressure in terms of central government borrowings. And obviously, I think the RBI is there to probably help and assist and abet at this point of time. A similar fashion was probably done between 91 and 97, where RBI did come to the aid of the government in terms of carrying out this entire expansion of borrowing mix and the borrowing program itself. I think a similar mode can be adopted at this point of time. A lot of countries and a lot of nations will actually breach their fiscal deficit numbers, at least for this financial year. But I think it's well accepted, well taken by the markets. Now, how the markets have reacted, I think the obvious reaction in terms of once the pandemic news started circulating and taking a global shape, obviously, I think the hit on both these counts, as I said, GDP as well as corporate earnings, it was given. Earnings have started trickling through. So the initial earnings that I was looking through, specifically on the S&P, I think that is not showing a pretty picture, and that again has been reflective of only 11 to 12 days in terms of economic slowdown. What will be seen greater will be Q1, Q2, and that's a consensus which has probably come through specifically for the Western developed world. So in that respect itself, again, expecting a slowdown to come through in earnings is what the markets have probably gestated to a large bit. Now, what you've probably seen in terms of the fall from the top and then the intermittent rally that we've probably seen from the bottom, whether it's the Dow, whether it's the S&P, whether it's the DAX, the CAC, Hang Seng, Shanghai actually have been far more resilient, because the data that is probably coming out from those shores is far better, and they've actually come to the end of the pandemic or the curve, and economic activity has actually started off. The second element obviously is in terms of which sectors probably get impacted the most. So I think banks, anything which is highly correlated with economic activity, aviation, hotels, hospitality, I think those sectors have probably borne the brunt in terms of the market fall. I think the ancillary effects are now being started to witness in terms of ancillary sectors like real estate, for example. Because I think if the entire notion and logic of working from home, of optimizing costs in a far more efficient manner, I think does that have a huge play in terms of annuity or rentals for a lot of these commercial players. I think time will decide that over the next few quarters on how activity actually starts shaping and building up. The second element is obviously in terms of, as I said, I think the sectors, even if they're going to get worstly hit, I think input costs, even if they've come off, for example, the aviation sector, I think even if crude has come off significantly, which is a large part of their input costs, what happens in terms of on the top line with planes not flying, with expectations of leases, I think with the rupee depreciating, having a huge hit in terms of rupee translated revenues, the parking charges that has to be played out. All these factors, I think, are something that needs to get counted out. The second element, obviously, is also certain sectors where I think consumer demand will come back, but will come back very, very softly. So if you leave aside FMCG or staples, which are probably more of regular use at this point of time, I think high ticket discretionary items might actually start getting deferred over a period of time. So in that sense itself, my own logic suggests that it might be a substantial hit as far as company balance sheets are concerned. So I think it's a classical situation when you compare it with previous crisis periods as well. You're probably going to see more in terms of comparisons drawn between 2008 and 2020 at this point of time. We've actually drawn comparisons for 2004, 2008, 11, and 15, and the current one as well. But I think 2008 is something which has left a huge dent. Because the lower circuits which got hit in 2008, similar lower circuits got hit in 2020 as well. We did see a intraday corrective low for this crisis period at 7,511. We've seen a very, very sharp bounce back from those levels of 23 odd percent. Now, similar fashion, if you probably see on the 2008 crisis periods as well, it took 10 odd months for that entire crisis to emanate. But the second period of the fall, so first leg was very, very similar to what we saw, the fall to 8,500 for this crisis period, and the bounce back from there again. What we probably saw, the lower circuit being hit, and then I think the markets rebounding very, very smartly the same day itself. And then over the next few days, new intraday corrective lows of 7,511. I think the second leg is something that has also played out perfectly to 2008. So from that intraday low, you've obviously seen a huge bounce of 23 odd percent, which was very, very similar in 2008. And God forbid, I think if the market probably goes lower, I think was the third leg carried the market in 2008 65% lower. So again, I think 2008 was more of financial deleveraging. 2020 is more about financial and economic deleveraging playing out at the same time. As I said, I think the known factor in 2008 was financial institutions. The known factor in 2020 is both these factors combined together. So at this point of time, I think the hit over the next few weeks, apart from corporate earnings, is also how this entire pandemic curve starts flattening out and starts coming down. And that will give some amount of confidence in terms of the worst probably being over, which the markets are probably presuming that this quarter, the ensuing quarter Q1 in our context, Q2 in the context of the Western world is going to be extremely critical. And that has been given as a washout. So I think annual earnings have been adjusted to a large extent. The RBI move yesterday was very, very good in my opinion. So they targeted LPOs that they did of 50,000 odd crores with 25,000 odd crores towards the smaller based NBFCs. Reverse repos being reduced by 25 odd pips to 3.75. The LCLR going to 80% from 100 odd percent. And banks, I think the deferment of NPA recognition, I think, and the NPFC initiatives, I think that is where I think the entire issue where solvency crisis could have come in place, I think has been probably mitigated with the RBI move. So I think injecting liquidity into the system, incentivizing banks in terms of liquidity, I think all those moves are extremely critical. Now, in terms of respective moves that you probably are intending to see, I think global debt has also ballooned up. So it's not only one thing that the market is looking at. I think certain risk factors need to be watched out as well. Fiscal deficits are going to go for a tailspin for most economies across the globe because of the excess printing that they're expected to do and the expected excessive borrowing that they will undertake over the next few months to probably mitigate this crisis in a far more logical manner over the next few weeks. The third element, obviously, is GDPs are expected to take a hit. So I think the correlation of this economic deleveraging and financial deleveraging is going to hit us hard. We are presuming Q1 to be a washout and Q2 probably to soften. But if this extends further, my own sense is that there might be one leg where the softness might very well continue. Now, whether we see a V-shaped recovery, whether it's a W-shaped recovery, whether it's a square root shaped recovery, or a U-shaped one, I think it's only time that will tell. But in my opinion, again, I think being cautious in these markets because there is inherent pain. I think the markets have corrected for a very, very logical reason. And the logical reason is obvious when it comes to translation of earnings and GDP growth as well. From a sectoral perspective, I think what the markets have clearly given a thumbs up is pharma and FMCG at this point of time. What our methodology at William O'Neill suggests that CanSlim is something that we probably look forward for as a product. I think a lot of you users might be using CanSlim at this point of time. So largely, again, I think the attributes towards CanSlim, earnings, current earnings, annualized earnings, the newness in terms of products, etc., in terms of the leadership position or the Lagarde position that stocks have, institution holding, and the market direction becomes extremely, extremely critical. So I'll quickly take you through a presentation for 10 minutes and try to answer questions for 10 minutes. If I'm not able to answer all the questions, I've requested the 5paisa team to forward the questions to me and my team. So in that regard itself, we'll try and get back to you in terms of most of the questions that you probably got as per our methodology and how we look at things both from a stock and a sectoral perspective. So clearly, I think this is in no way recommendations. I think this is just educational. So that's a clear compliance disclosure that I want to bring about. So this we discussed at this point of time. I think clearly in CanSlim, market direction becomes extremely important. So I think the four different market statuses that we strongly rely upon are expected to be kept in mind when you're probably looking at taking positions or having positions both from a trading or an investment perspective. Now, we are clearly into a rally zone at this point of time because from the intraday corrective lows of 7,511 that we've seen, the market has strongly rallied, as I said, of 23 odd percent. We've already seen three positive trading days happen through with good volumes and good price action. After those 3 days, as we call it as a rally attempt from the corrective mode, we also witnessed a follow-through day. Now, what is a follow-through day? A follow-through day is when an index, for example, Nifty, gives a 15.5 to 2% move at the index level with volumes better than the previous day volumes. So you already witnessed a follow-through day on March 31st where the index showed a huge move. It did show some amount of correction in the day after that in view of global markets. But after that, I think the move that has come through has been even more fabulous with markets reacting 4 to 5%. So there was one more solid follow-through that we observed at this point of time. Now, the important part to see is on the right-hand side where there's an under pressure and the corrective mode where distribution days become extremely critical. Now, what is a distribution day? A distribution day is nothing but where the index corrects 0.2% compared to its previous day's action on volumes higher than the previous day action. So if you witness 3 to 4 of such days in 3 to 4 weeks, it's an obvious telltale sign that the markets is giving that there is something wrong in terms of the market direction. At this point of time, I think any high exposure towards high beta correlated stocks should be probably observed, and to that bit, taking some money off the table should be mandated for these high beta correlated stocks. If these number of distribution counts or days increase over the next 2 weeks and increase beyond 5 or 6 in the next 5 to 6 weeks, in the next couple of weeks, the market obviously from under pressure is indicating that it is getting under tremendous amount of corrective mode, and there is the market goes into the correction phase. We've seen all these phases play out over the last few weeks. We were in a rally attempt till the end of February. Number of distribution day count actually increased in the next 2 to 3 weeks, 3 to 4 weeks that followed, and there was sufficient enough of stack up of distribution days even after that in the next couple of weeks. And that market direction change from a rally to a rally attempt to an under pressure attempt to the corrective mode in a matter of weeks. Now we had to wait till the market went through its volatility, but we saw 3 solid days of action, which we count in the rally attempt days. And we also saw, as I said, a solid follow through day, which has given market the strength at this point of now. Now, whether it is sustainable at this point of time, I think one really needs to be very, very watchful. We are very, very cautious because as we've seen in the past and previous crisis periods as well, there are inherent pullbacks, and pullbacks, as I said, when I compare with 2008, similar pullbacks have been observed in this space too. And to the T, I think there was a 23-25% pullback from lows. We've already seen a 23% pullback. There is a possibility with global markets closing higher in Friday's trade that the positive momentum probably continues in Monday's session as well. But I think a large element in the first part of the market move has been because of shorts being covered in the system. But the confidence will only return once I think the pandemic curve starts flattening, it starts coming off. There is positive news in terms of Gilead, US pharma company, actually having positive results with a batch of its patients in Chicago actually having and meeting out strong results orientation. But how does it happen on a large scale is something to be seen. So I think all these factors are very, very critical, but this is the market status that I clearly wanted to share. We've already discussed this in terms of distribution days. The 3 days, as I said, for the rally attempt have to be very, very positive in terms of price volume action. And the follow through day, which follows after that between the 4th and the 25th day, has to be a solid day with the index moving 1.5 to 2%. But we need to wait for a follow through day. That has come. There also has been a second follow through day with the index moving 4 to 5%. And therefore, I think the status which got changed to confirmed uptrend on the rally attempt and certain sectors, I think, which probably are meeting the EPS rating, the RSI rating in terms of base formation and structures being formed. Pharma FMCG have done phenomenally well over the last few weeks, and their performance in terms of an earnings outlook compared to the other sectors, even if the hit will happen for them as well in Q4 and Q1, will not be as substantial, and therefore the market is trying to find some amount of protection within these two sectors itself. So we discussed what a follow through day was. Excuse me. So the follow through day, as I said, helps to identify the new uptrend that the markets see. We also expect to see certain sectors and certain stocks react very, very positively in a follow through day. We obviously seen what a distribution day is, and accounting for these distribution days becomes extremely critical in gauging and determining the market direction. So I'll just pause here for a minute in terms of how the market had moved for the entire part of last year. It was a very steady move. September 23rd, when Nirmala Sitharaman proposed the corporate tax cuts, you saw a solid follow through day happen there, and the market moved into a confirmed uptrend, which was very, very sideways till that point of time. Obviously, I think the budget also was taken in a sort of a knee-jerk reaction by the market on the downside, but they reacted very, very positively because liquidity was very, very strong in the system. But as you see, I think as the pandemic news started becoming more global from the end of Jan, the number of distribution days or the distribution day count started increasing. So the market started coming under pressure. The number of distribution days, in fact, had stacked up quite significantly. We had downgraded the market very clearly as the distribution days stacked up. And post that, I think the knee-jerk reaction that we probably saw in the markets is now history that has happened in the last 2 weeks. We've also seen a knee-jerk reaction. But as I said, I think being cautious because there might be a leg downwards that the markets might still give us because the markets have still not understood fully the entire impact from the financial and economic deleveraging that will play out over the next few weeks and months. It's a very interesting day. I think that's obviously the choice that comes through with such a huge move that comes through. I think a lot of investors, traders obviously have the feeling of missed out. So the FOMO feeling probably still exists. And that is very, very obvious and very, very psychological as well, because you're seeing prices move up and you feel that you probably missed out. But it doesn't happen that way. In the own sense, I think with the pandemic and the 3C'S, as I said, Corona, Crude, and credit risk averseness, I think these three factors will have a huge say in terms of earnings degrowth still playing out for a lot of sectors. And these sectors and stocks will react as numbers start coming out, as commentaries start coming out. Instance taken point, TCS, post the numbers, and in the management commentary, they clearly pointed out towards the scenario being as bad as the global financial crisis. Now, remember, in the global financial crisis, this was only the financial part that we probably were looking at. Here it is far higher. Yes, central banks have come to the rescue at this point of time. Central governments are printing money. There is a lot of helicopter money that is being thrown out, a lot of packages being thrown, but it is coming at an expense where I think global debt is ballooning. There is high expectations in terms of almost 20 trillion of bonds being coming up for renewal over the next few quarters. So I think there are some telltale signs at this point of time. But I think there are also some positive aspects. The number of corporate bond issuances in the US markets have gone up significantly, which also says that the credit market is probably looking in fine metal, at least as the US is concerned. But I think a lot of other data points are offsetting that in terms of the unemployment claims as well. So 21 million odd over the last 4 weeks was a similar number in terms of jobs created after the financial crisis. So one must understand and assume that a lot of these data points can actually play out far more negatively than what we are expecting at this point of time. Therefore, I think remaining extremely cautious, remaining a little bit more selective in terms of sectors and stocks is going to be extremely critical. And the next 2 to 3 weeks are extremely critical in terms of how the pandemic pressures play out and whether earnings are able to support the kind of market move that has been seen from the bottom. Now we'll just compare a few of the crisis periods from 2004 right up till 2020. As I said, I think the follow-through day is a day where I think 1.5 to 2% of a market move happens on an index with volumes greater than the previous day's volumes. Every crisis period had follow-through days which were exhibited, but the first follow-through day gave up after the initial gain. The second follow-through day also, I think, gave up quite significantly in most of the crisis periods earlier because the markets were trying to grapple with a lot of information in terms of how the financial implication and the economic implications were on sectors and stocks for financial markets and risk on markets like equities globally and locally as well. The third follow-through day, however, I think took the market into the brilliant bull market rally that we saw from 2004 to 2008. Yes, there were inherent and small pullbacks seen between these periods as well, but largely I think that rally sustained in a far more linear fashion from that time period. Just pause in terms of showing you the chart on how 2004 played out. Obviously, as I said, I think the first follow through, even if it was witnessed, I think it still managed to, I think, take out its lows, because that is how volatility plays out in the market. There are pullbacks, there are significant pullbacks that are seen 2008, which I'll take you through. I think has seen significant pullbacks in terms of market rallies. But again, I think the the fallout from there, I think, also has been very, very obvious, because I think it's not an obvious scene where money gets printed, but demand genuinely has to come back. Whether that demand comes back in a V-shaped fashion or very, very gradually in a U-shaped fashion will determine how strong this market recovery will be and whether this market recovery can sustain. 2008, clearly, as I said, I think the fall that I was talking about, right, it was a far greater fall from the second leg. And we are actually replicating the move in terms of the second fall and the second pullback as well. The last fall that you see of almost 50% was terrible, because I think there the markets realized that we are not in a safe zone. I think what has happened in terms of financial and economic deleveraging is far worse, and this is going to take far longer period of time than what initially the markets were anticipating and expecting. So this time round as well, I think we are assuming, as I said, uh, this quarter, I think Q4 in the Indian context to be a little soft, Q1 to be extremely soft, the Q1, Q2, and Q3 from a developed world perspective to be extremely soft. But God forbid, I think if this extends in terms of demand not recovering as fast as one expects, and if it extends for a quarter or two, I think you've got all your analysts' expectations in terms of consensus earnings numbers, in terms of GDP estimates actually going out of the window, and markets starting to realize that and factoring in it a couple of quarters, because we'll get all those data points over the next few months over a period of time, how the year is playing out, and that can play out front in terms of how the market move can be. So sustainability probably remains still a question mark. Whether there's a leg down, there is a huge possibility of a further leg down. How much, difficult to quantify at this point of time, but as history suggests, I think you might be actually staring, if any of these factors actually go front over the next few weeks, of market trying to at least retest what it has done in the previous few weeks. Just take a moment to pause in terms of how the 2008 chart played out. Again, I think a lot of follow-through days were misleading. We also undercut a couple of times in terms of market move. I think market sentiments obviously are trying to find out positive news, positive action. I think that's a very good thing, but I think that has to get substantiated by numbers, and it's numbers and market data and market direction which will tell us everything. So I think instead of being ruled by individual biases, I think these three factors will be extremely critical in terms of gauging and judging market move and market direction. 2011, again, I think similar moves exhibited. yes, the move that were seen in all these earlier crisis periods, the time to find the bottom, the time on how the market corrected took a long time. 2020 really didn't give us a chance. So I think the kind of knee-jerk reaction and sharp correction that we saw and witnessed in the markets was something that nobody had fathomed. But largely, again, I think if you follow the rules set out in terms of William O'Neill, I think at least you have a safe chance of at least conserving capital. And to that bit, again, I think staying on the sidelines till this entire move got played out in terms of the bottom getting created, the follow through day observed, I think, and then getting into the market at least gives us some surety and individual allocations and selections in terms of the stocks that can have stability in terms of market move. So 2011 had similar moves that got exhibited. The follow through days, again, the third follow through day actually undercut its low, even the first one, which obviously meant that Nifty again went back into a corrective phase, and we had to wait for a proper follow through day, which came only after a few months. And that again had to be played out quite rightly, because that follow through day, once it took out its key averages and started moving higher, I think a lot of sectors and a lot of data points had become far more clearer from the next 12 months perspective, and a lot of froth which had built into the system and a lot of pain had got captured in terms of numbers and earnings. Similar for 2015, though I think 2015 the number of falls and pullbacks that we probably saw were lesser. But again, I think the kind of expectation that one had in terms of the market fall and the market reaction in terms of the rebound were played out in terms of the market move itself. But the third follow through day which came through, I think, had a huge move, like in the previous occasions on 2008, 2014 as well. So I'll just quickly pause it for a second to help you gestate the chart. So in each of the previous crises that you see, I think there has been an undercut which happened even after a follow through day was observed. Whether you'll see that this time around in 2020, not really sure. But again, I think assuming the complexity in terms of how numbers might play out, the complexity in terms of a combination of this crisis playing out in 2020, I think it's better staying safe rather than sorry. So I think being selective, as I said time and again, is extremely critical. But I do expect that the markets might consolidate around these levels. If data points worsen off, you might have a leg downwards, as I said. But I'll try and attempt a few questions from so I'll try and attempt a few questions that a lot of users have pointed out. Yes, I think there have been some queries where time probably has been a constraint. I absolutely agree on this one. What we'll do is next time, I think we'll probably have a far more elongated session where I think we can have far more structural discussions in terms of how sectors will play out, what is the implication in terms of global debt, what are the implications in terms of the earnings yield, how bond yields are playing out. So I think there are a lot of discussions which can come about and which can be a continuous process as well. So I will have a word with the 5 team as well. Maybe we'll have an elongated session next time down. Pharma, I think there is one question. Can pharma continue its performance? The user has cited an example, Alchem and Sun Pharma, for example. My own sense is that with the retaliation that the US might do towards China, and where China has become a sore point for the US president and the US markets as well, the kind of approvals that we're seeing specifically in terms after the hydrochloroquine has been supplied to US shores and a lot of other countries, the approvals that are coming through, because a lot of FDA plants, apart from India, lie in China and other Southeast Asian economies. Now, if a retaliatory move has to be taken, I think a lot of these Chinese plants will come under scanner, which means that the Indian production units should be working at optimal capacity to probably cater to the US needs and the global needs as well. So you would have seen over the last few weeks far more approvals coming through in terms of key specialty products that have got approved. FDA plants are actually getting EOIs and VAIs, which means that the clearances that one was expecting to come through the end of FY21, both from a plant perspective and a product approval perspective from a specialty pipeline, and not the generic drugs where pricing pressures were observed. I think that will critically give mass to a lot of these pharma firms. Pharma sector was obviously under a lot of pressure over the last few quarters last year as well because of all these concerns, but it's coming out because of all these reasons that will play out. So positively, earnings will play out. It's a consensus trade which is played out. But I think we as a methodology had identified this a few weeks back. So pharma, FMCG were two sectors where we probably saw a huge recovery taking place. That is precisely how it is played out. And we have remained extremely positive and remain extremely positive about pharma and FMCG. For FMCG also, I think compared to the other sectors, yes, utilization levels in terms of factory output still at 40, 50 odd percent. You are expected to see volumes actually grow because of optimal capacity not being there at 80 to 90% and working at half that capacity. Also against transport related issues, you've got packaging related issues, so on and so forth. But I think the earnings will be relatively better, as I said, towards the compared to a lot of the economic facing industries as well. So yeah, FMCG pharma probably stay there on our radar in terms of sectors which will be positively impacted both from an earnings perspective as well as an earnings recovery perspective over the next few quarters. There are a few questions in terms of cement. For cement as a sector, my own sense is this quarter typically becomes a very critical quarter with lockdowns still being effective in large parts of the country where the plants are, and with expectations from April 20th, activity expected to resume. Partial operations for cement should start coming through, and a lot of push through will probably happen towards the dealer end as far as cement companies are concerned. Now, nationwide cement companies who have a large presence between north and west of the country, the pricing has at least remained very, very constant. Input costs obviously has uh, input costs have obviously stayed benign, but over the last few weeks, you actually seen some element in terms of rise, both from iron ore and coking coal, and that again I think will have an impact because I think if the entire leverage from a volume-led price perspective is not played out, the operating leverage for cement companies in terms of EBITDA per ton that they report, and from an enterprise value to ton perspective, doesn't get reflected very, very effectively. Again, I think typically Q2, Q3 are quarters where the monsoon plays out from an Indian context and activity and execution becomes extremely soft. Q3 is where initial parts of recovery start taking place, and Q4 probably becomes the strongest execution quarter. So nationwide cement companies having presence in the west and north probably expected to do well. Utilization levels are around 70 odd percent. South-based companies still typically facing problems of volumes being pushed because of competitive pressures, pricing still remaining under pressure, and reported EBITDA per ton still remaining extremely soft. For pharma specifically, I think questions being asked what stocks. I think Alchem, yes, I think this is one stock that probably looks very, very attractive, both from an earnings perspective, from an EPS rating perspective, and RSI rating perspective, and all the factors that probably support the fundamentals and technicals as well. For the financial sector, I think certain questions are being asked on that front. Financial sector is going through a stress. So I think the 3C'S, as I mentioned, I think the credit risk awareness is clearly getting played out for the financial sector as well. How the loan growth and advances happen over the next few weeks is going to be extremely critical because what you've seen in the lockdown phase is that advances growth is going to remain extremely soft. Case in point, I think if you probably look at Bajaj Finance's numbers were extremely soft on a quarter-on-quarter basis, both in terms of loan growth, AUM growth, and though they have got the cross-selling ability for their SME database that they've got, the other concern that the markets have is exposure towards MSMEs, the unsecured sector, which probably puts the lending under stress, which puts the asset quality under stress, and where GNPs, NPS can actually come under a huge amount of duress. Having said that, I think if this um, uh, double whammy effect starts playing out on balance sheets, the provisioning that will be required will be far higher. Yes, capital adequacy for a lot of these better run NBFCs, better run banks are extremely robust at this point of time. But I think the pool that they're lending to, even private sector banks, if you observe over the last 2 quarters, have been have been uh, b- have been lending to credit cards, have been lending to the personal loan holders as well. So in that respect, you probably need to monitor how the earnings are expected to take place. MCLR it needs to get readjusted with advances growth, with what happens in terms of the deposit franchise as well, because readjustment need also to be done on the deposit rates. For a lot of the rural focused, agri focused NBFCs, what happens in terms of the collection efficiencies are going to be extremely critical because a lot of the end users are obviously users who depend on daily wages, who depend on agri as a theme, which has obviously come under a lot of stress. So there might be some stress in terms of collection efficiency as well. In terms of asset quality pressures that will get played out on this side of the business as well can also be quite substantial. And again, I think the borrowing that they probably do in terms of banks, I think the kind of hit that they take on things and spreads can be relatively higher. The RBI move obviously is very, very good for NBFCs, but that's sentimentally positive. How does that play on numbers is going to be extremely critical. So I think the entire financial system, I think the numbers need to get closely monitored and closely watched out for. So let me find out a few more questions that I can probably answer in the next 5 or 7 minutes before we probably call it a day. Automotive sector, again, I think a few questions that have got asked there. Automotive sector obviously has seen a lot of stress, not just for the last quarter, but the last entire financial year. Demand had slowed down. The NBFC crisis, which got played out, had a huge liquidity impact from a dealer perspective. The norms that got changed over the last 2 quarters from BS4 to BS6, the entire inventory had to be disposed of, which means the BS4 inventory had to get offloaded at discounted prices, which all the companies were trying to do, whether it's two-wheelers, four-wheelers, MSCV players, CV players, LCV players. Again, the transition costs itself are quite substantial because a lot of changes were expected to be done in terms of getting the models ready for BS6. Example and case in point for two-wheelers, from the carburetor system to the electric fuel injection system. There were also the ABS needs that happened in the early part of the last financial year, which jacked up prices by 4 to 6,000 odd rupees on an average for two-wheelers. So the additional cost makes ownership of vehicles far more dearer. But again, I think there is an alternate argument being put out. I think if these rules get played out, and the Maruti chairman, Mr. Bhargav, was put on record saying that if these rules of social distancing start coming through, I think far more ownership will start coming through instead of shared vehicles being used, more pool rides being used, and so on and so forth. But it's a matter of time. I think what really plays out for the auto sector is that the first half is going to be extremely, extremely soft because both the domestic and global facing auto companies are going to feel the stress on all these factors coming together. For European companies, there is an added stress in terms of emission norms as well, along with the added capital expenditure required for electrical vehicle mobility as well, where a lot of impairments have taken place. Case in point, Tata Motors has taken a huge impairment hit from a cash flow perspective for their JLR business. So even the ancillary universe, largely dependent on the OEM space, whether it's tire makers, battery makers, whether you're talking about bearing companies, all of them are going to feel the heat. Rubber prices probably have come off for tire makers, so I think a sentimental trading move quite possible. As plants start coming back on stream, there is every expectation that RSS4 prices, because of oversupply that we've probably seen, might play out in the positive direction for tire companies. But with that respect, again, I think will demand come back? The replacement demand still holds good for a lot of these stocks, but the original equipment manufacturer or the original demand still remains extremely soft. So in my opinion, there is softness for the first half for the auto sector. Earnings have largely got diluted on an annualized basis. So I think the entire second half, and if the scrappage policy does come through, might provide some amount of earnings support for the auto sector as a whole. For the market in general and how the cards issue might play out, SBI cards, I think a lot of enthusiasm drawn out. But again, I think for this element, again, I think a large element happens towards the unsecured lending element. It is largely unsecured lending as well, which means that the asset quality pressures might actually get accentuated for a lot of these credit card companies. Yes, it's got a niche, HDFC credit cards, SBI cards, strong parentage as well. I think all these factors are very critical to be observed. So I think these quarters numbers are going to be extremely critical. Similarly, I think stocks like IRCTC, just a case in point, I think how numbers will play out will be extremely critical because the lockdown pressures that we've seen, there is a huge refund that they probably need to do for cancellation of bookings. How we come back on track and how the entire lockdown is lifted partially, even in terms of train and rail travel, is going to be extremely critical in terms of the financial performance. Is the models, I think the model is absolutely all right. So in my opinion, again, I think the monopoly that it has got in terms of bookings, the EBITDA margin that they generate, the F&B revenues that they generate, I think it's all in the right spirit. But I think the temporary hit and the medium-term earnings hit that the company will take, and the sky-high valuations that it was trading at. I think that probably needs to be observed at this point of time. For FMCG again, and this is probably one of the last questions that we'll probably take because we might run out of time over the next few minutes. The sector has been doing exceedingly well. So as I said, I think over the last few weeks, I think we identified that the sectors which will be far more resilient from an EPS rating perspective and the RSI strength were also extremely good for the sector as a whole. At this point of time, even if these companies within the sector are performing at 40-50%, and as the capacity ramp up starts happening gradually and smoothly, I think the operating leverage will start playing out. Yes, I think the expectations in terms of Q4 numbers might be a little bit soft, but going forward, I think when you're probably talking about how the entire move might happen as things normalize over a period of time, you're expected to see far greater traction come through from this sector as well. And as I said, I think the earnings resilience that this sector will throw up compared to a lot of the economic facing sectors or the correlation that a lot of sectors have to the economy, whether it's banking, financial services, aviation, hospitality, hotels, film exhibition stocks, realty stocks. I think these two sectors might hold up pretty well. So I think volumes might take a miss or a hit in Q1, but I think the volume-led price growth should be good. Something on oil and gas. Obviously, I think what you've seen in terms of correction of crude prices, upstream companies obviously take a hit because I think a direct correlation happens in terms of net realizations on how crude prices move. At the same time, I think you're probably looking at refining margins. I think the product mix that you've got, middle distillate companies obviously are at a big advantageous position because of the new IMO regulations. But you need to keep an eye in terms of the crack movement as well. So how the gasoline cracks are moving, how naphtha cracks are moving, and how's your complexity index in terms of your individual plants where you process crude is going to be extremely critical. Example, again, I think IOC's Paradeep plant has an extremely high Nelson complexity index, which makes it one of the most efficient plants, apart from RIL's plants that it has got. Though RIL has a lot of options in terms of feedstock, I think all these other players might actually witness, even from a downstream perspective, advantageous inventory losses because they would have bought crude at a higher level. Crude has suddenly corrected. They still need to process crude at a certain level, which basically means even if there are shutdowns for petrol pumps, so on and so forth, they still might take a hit unless crude recovers to that point of time. So again, I think oil and gas is probably in a limbo at this point of time. Gas distribution companies probably still remain in the sweet spot in that point of time. Yes, CNG stations also getting closed, but input costs have come down significantly. So as a basket, I think gas basket has come down, and the revised rates at 2.39 MMBTU are significantly lower. You've actually seen stocks, again, a case in point, IGL, for example, reduce costs in terms of CNG and PNG as well. So with that respect, again, I think the volume growth and new geographical areas that come out clearly lead to leverage for these companies. Are they expected to take a hit? Obviously, yes. I think the hit is also expected to be there for gas distribution companies in Q1. But relatively placed on balance sheet strength, I think they're relatively better placed compared to their upstream and bottom stream components. Again, I think there was a question why market is moving up and the corona is or the bad economy is out. I think it's more a case in terms of expectations and hope from the market at this point of time. We are presuming that over the next few weeks, as I said, I think the pandemic curve will get over. As I said, the Gilead experiment very, very positively taken, at least for the initial test that they had conducted. The huge economic stimuli that has got announced by a lot of central governments across the globe are being taken positively. But there lies the concern as well. And that's where my entire thesis lies in terms of being cautious, because global debt have shot up significantly. Global GDP is expected to take a huge hit. Fiscal deficits are gone out of a spin at this point of time. Central government borrowings are going to go through the roof in terms of providing and bridging this gap in terms of the additional borrowing that is expected to take place. But the most important and critical part is how will demand come back? So we are assuming that after this quarter, demand will come back in a V-shaped manner. If that does not happen, and if there is still pain that probably persists within the economy itself, you might see that the markets will then eventually come back to reality. That's why I said being cautious, and whether there's an extreme high element of probability and a chance of the market probably showing a leg down again, I think that still exists and persists in the market. So I'll just take one last question. As I said, I think any questions that I miss, we will obviously take it offline. I've asked the 5 Paisa team to forward me and my team the questions, and we will come back with relevant answers ASAP for these questions as well. I think the last question obviously was what about the Nifty P? Obviously, the correlation in terms of how the Nifty P moves is earnings. So it's how price earnings moves. So how the Nifty is based at this point of time with the consensus earnings estimates of the Nifty 50 stocks. There is a fair estimate that there is a high single-digit probability of earnings degrowth happening on an annualized basis for this year. But here we are assuming a few weeks lockdown happening in Q1. If that pain persists, as I said, and the demand happens in a slow U-shaped fashion, that earnings hit might actually happen from a higher single digits to the mid-teens, which means that the consensus Nifty EPS that we are talking about can further get downgraded. Which, as I said in my opening remarks, I think the initial reaction that you probably saw in the markets were obviously, I think, legitimate. And then I think there will be some element of realizations of readjustment happening in terms of Nifty levels as well. So I think Nifty, the next few weeks in terms of the pandemic curve, in terms of earnings outlook, not just for us, but keeping a close eye on S&P earnings as well. A lot of US bankers US bankers will probably report numbers in the coming week. A lot of IT firms will report numbers, and their management commentary will be extremely critical from a global perspective on how we are positioned and our own results as well. So thank you very much. I think I've requested the team, as I said, I think we'll probably have far more constructive discussions on a far more regular basis. It was a pleasure speaking to you guys. You stay safe, stay healthy, and in my earnest opinion, I think the next few weeks we'll be able to conquer this pandemic and hope the markets keep on moving back on that side. Thank you very much.